This year marks the 150th anniversary of the Dunedin Income and Growth Investment Trust. Founded in 1873 in Dundee by financier Robert Fleming, the then named Scottish American Investment Trust focused on the emerging market of the United States. Now, Digit selects companies within the UK and European market, selected for their growth in capital and income. So whilst the geographic scope of the investment trust has changed and the name, the ethos remains the same. That is to develop a diversified portfolio of companies which investors can take a degree of comfort in when faced with uncertainty in the economic outlook. The trust is differentiated in three ways. It has active positioning, resilient income delivery, and a sustainable and responsible investment approach. There are currently 36 holdings in the portfolio and high active share. About half the portfolio is invested in the FTSE 100, with 25% in the UK mid-cap space. 2022 was a particularly challenging year for UK mid-caps, but fundamental analysis of company prospects points us to a number of interesting opportunities, and we feel that the alpha generation, which has historically come from the UK mid-cap market, will return. The remainder is held in selective European companies, which provides the investment trust with diversification benefit and enables exposure to a number of unique opportunities that would be unavailable to funds that are restricted to the UK market. The portfolio has got a carbon footprint which is about 2/3 that of the benchmark, and the fund is rated AAA by MSCI. The UK market has had a turbulent start to the year, and in March the market declined on concerns about the stability of global financial system. This followed the collapse of the US-based Silicon Valley Bank and the emergency takeover of Credit Suisse. Given this environment, it's pleasing that the portfolio has outperformed and provided a more resilient return compared to the benchmark. We are also pleased with the income delivery of the investment trust, and the dividend yield of 4.4% is at a premium to the market. Since our last update, we've built our position in Oxford Instruments. The company provides specialist tools for academic and industrial users. The company's got a high degree of intellectual property and serves a range of industries, including semiconductors, advanced materials, and quantum computing. The company has been building its service offering, and this should be supportive of margins in the future. And in addition, its net cash balance sheet provides optionality. The company's robust order book and broad offering provide a strong outlook for growth, and we think this is not captured in the valuation. In addition, we took the opportunities to top up in AstraZeneca and London Stock Exchange. Both companies have got market-leading positions and attractive dividend growth outlooks. To fund these purchases, we exited the emerging market debt asset manager Ashmore, where shares had bounced on improved sentiment to the asset class, but we were cautious on the ability of the company to generate flows. We took the decision to exit Direct Line Insurance after a disappointing meeting with the company that pointed to a slower pace of operational improvement. The company has cut its final dividend, and the outlook for dividend distributions remains uncertain, which has impacted our rationale for owning the company. AstraZeneca is a leading pharmaceutical company with a focus on oncology, respiratory and cardiovascular biopharmaceuticals, and rare diseases. The company is headquartered in Cambridge, but has got a well-diversified global footprint. The industry is complex with high barriers to entry, and AstraZeneca's position is supported by its 13,000-strong research and development team. The company's got a strong and diversified pipeline, including a number of blockbuster drugs, which provide an attractive outlook for growth. AstraZeneca has strong societal benefits. increasing access to life-saving treatments and improving the resiliency of healthcare systems. Volvo manufactures and services commercial trucks and construction machinery. This is a cyclical industry, but we see the company as being a relatively high-quality player within it. The company's got a robust pipeline and order book, and this provides a strong outlook for growth. In addition, the growth of its services business should improve the profitability of the company and its resiliency through the cycle. From an ESG perspective, the key theme is how Volvo manages the transition from the internal combustion engine to electric vehicles. And pleasingly, the company is in a leadership position in this regard. It has a leading market share in Europe and in North America in electric trucks. In addition, the company sees an interesting opportunity within hydrogen fuel cell technology for trucks which are travelling longer distances and carrying heavier load. There are a number of themes playing out in the market. Two of note are that of the high level and persistent inflation and concern about the banking sector resiliency. On inflation, we've been reassured by the performance of companies held in the portfolio that have managed the highest level of inflation in a generation. We heard from companies last year that were managing supply chain bottlenecks, for example, in the semiconductor industry, and extreme levels of energy volatility. A number of these inflationary factors have eased this year, including, for example, freight costs, which have come down. And instead, the focus has turned to the labour market and the level of wage inflation that the companies see going ahead. It remains a tough environment, but we continue to expect companies which have got strong pricing power and nimble supply chains to be relatively well positioned within this market. The second theme is around the banking sector and resiliency. Following the collapse of the Silicon Valley Bank and the emergency takeover of Credit Suisse, there has been a focus on the secondary impacts of what has been a fast pace of interest rate rises. Whilst the portfolio is overweight financials, it is underweight the banking sector. This is due to the portfolio's focus on quality and fundamental bottom-up analysis of the companies in the UK market. We remain cautious on the outlook, as we have been for a number of months, but we're reassured by the resiliency of the portfolio and believe there's enough balance in the portfolio to perform in a range of market environments.